Today, no recession for now. Hello again, it's Martin North from Digital Finance Analytics. I've noticed posts covering finance and problem news with a distinctively Australian flavour. While the official arbiter of recessions in the US, the National Bureau of Economic Research's Business Cycle Dating Committee uses the average of two measures: inflation-adjusted gross domestic product, GDP, and gross domestic income, GDI, the latter a lesser-known official measure of economic growth, along with a range of other economic variables when making its recession call. And overnight, we got a GDP update from the Commerce Department, and they said inflation-adjusted gross domestic product, or the total value of all goods and services produced in the US economy, decreased by a 0.6% annualised rate in the April to June period. That reflects an upward revision to consumer spending and compares with a previously reported 0.9% contraction. But on the other hand, gross domestic income climbed at a 1.4% rate in the second quarter after increasing 1.8% in the first 3 months of the year. This metric measures activity by calculating all income generated from producing those goods and services, like compensation and company profits. In effect, the government's main measure of US growth pointed in different directions in the first half of 2022, adding to the ongoing debate on the health of the US economy. The average of GDP and GDI actually rose 0.4% in the second quarter after a 0.1% increase in the January to March period. So, theoretically, GDP and GDI should be roughly equal, but in reality, they tend to differ, especially in early estimates. But the current gap is particularly large, and of course, you can say, therefore, that the US economy is not in recession. The GDP figure suggests an abrupt slowdown in economic momentum in the first half of the year, yet below the surface, there's more at play, including the impact of volatile categories like imports and inventories, but overall consumer spending has deaccelerated. The back-to-back negative quarters, a common rule of thumb for recessions, have not only fueled fears of an imminent downturn, but also led some to believe it was already well underway. GDI, however, points to a more gradual cooling. It paints a picture of an economy supported by a robust labour market and resilient consumer spending, though one that's starting to feel the pinch of the worst inflation in a generation. We continue to think that the decline in real GDP across the first 2 quarters of the year does not meet the NBER's definition of a recession. And if the GDP data is eventually revised up to a more consistent level with the GDI data, the first half of the year may end up looking stronger or less weak than the data currently shows, JP Morgan said. Separately, on Thursday, a report showed applications for US unemployment benefits fell for a second week, suggesting that employers are holding on to workers despite growing economic uncertainty. Consumer spending, which accounts for the majority of the economy, expanded and upwardly revised 1.5%. That compares with the previously reported 1%. And Thursday's report also included the government's initial estimates of corporate profits in the second quarter. Adjusted pre-tax corporate profits increased 6.1% from the prior quarter. That's the fastest pace in a year, after falling 2.2% in the first 3 months of the year. Profits are up 8.1% from a year earlier. So along with consumer spending, private industry investment was revised higher, though it remained a drag on the headline figure. And residential fixed investment was adjusted lower, the data showed. Looking ahead, forecasters expect GDP to bounce back in the third quarter, but recession fears do remain elevated. And the Federal Reserve is aggressively raising interest rates, of course, in an effort to cool the economy enough to stem price pressures without causing a recession. So far, the clearest impact for consumers has come in the form of jumping mortgage rates and ensuing sharp slides in the housing market. Fed Chair Jerome Powell could point to such developments as evidence that the central bank's policies are working at his annual Jackson Hole Symposium, which is currently running. Powell is due to speak on Friday morning, when he's expected to restate the Fed's resolve to keep raising interest rates to get inflation under control. companies have sought to pass the rising costs of materials and labour onto consumers in the form of higher prices, weighing on America's ability to spend, and some firms have been able to offset the slip in demand by charging more for their customers, but others, like Target for example, saw inventories swell, forcing the company to employ steep discounting to clear stockpiles. While companies report individual profits based on historical costs, the government adjusts the figures to reflect the current cost of replacing capital stock, such as equipment and structures. So due to surging inflation, the current replacement costs are much higher. If you exclude that adjustment, as well as one for inventory valuation, after-tax profits actually climbed 10.4% in the second quarter. After-tax profits as a share of gross value added for non-financial corporations, that's a measure of aggregate profit margins, improved in the period to 15.5%. That's the most since 1950, from 14% in the first quarter. The Bureau of Economic Analysis will release its annual update on September 29th, which will include revised statistics for GDP and GDI for the first 5 years through the first quarter of 2022. The first estimate of third quarter GDP will be released on October the 27th. Now, traders see a slightly greater likelihood of a third 75 basis point interest hike from the Fed at its policy meeting next month, compared with a 50 basis point hike. Fed officials on Thursday were non-committal about the size of the interest rate increase they plan to approve at their September 2021 meeting, but they continued hammering the point that rates will rise and stay high until such high rates of inflation have been squeezed from the economy. Indeed, Kansas City Fed President Esther George, who is hosting the Fed's Jackson Hole conference this year, said that the Fed may have to lift the federal funds rate above 4% and hold it there for a time to bring inflation down. Anyhow, Wall Street ended sharply higher on Thursday, lifted by gains in Nvidia and other technology-related stocks. The S&P 500 climbed 1.41% to 4,199. The Nasdaq gained 1.67% to 12,639, and the Dow Jones Industrial Average rose 0.98% to 33,291. We're in a period of time between the end of the second quarter earnings season and meaningful additional data from the Federal Reserve. Markets are churning a bit with a reasonably low level of volatility, said Bill Northey, Senior Investment Director at UBS Bank Wealth Management in Minneapolis. The yield on the closely watched 10-year Treasury note faded after hitting recently 2-month highs, and declining interest rates tend to benefit technology stocks trading at high valuations. Low interest rates have certainly put some support underneath some of the more growth-orientated sectors, Northey said. Nvidia jumped 4% after the graphics chip maker gave a weaker-than-expected quarterly forecast that many investors viewed as signaling the worst of a sales downturn may be over. That drove a rally in the Philadelphia Semiconductor Index. Apple and Microsoft rose more than 1%, while Amazon and Google owner Alphabet added more than 2%, with all four companies making substantial contributions to the Nasdaq's increase. In fact, all 11 S&P 500 sectors rose, led by materials up 2.26%, followed by a 2.06% gain in communications. Electric vehicle maker Tesla, though, slid 0.35% after a 3-for-1 stock split came into effect. Following Thursday's rally, the S&P 500 remains down about 12% in 2022, while the Nasdaq is down about 19%. Citigroup climbed 2.1% after saying it plans to close its consumer and commercial banking businesses in Russia starting this quarter. And Salesforce fell 3.4% after it cut its annual forecast over measured spending from clients and a hit from a stronger dollar. Additional chip makers rallying on Thursday included Advanced Micro Devices, up 4.8%, and Broadcom, which gained 3.6%. Now, of course, investors will be focused on the Federal Reserve's Jackson Hole conference for clues about the central bank's policy outlook. The Federal Reserve Bank of Kansas City's annual gathering in Jackson Hole, Wyoming, got underway with a dinner on Thursday evening, returning to an in-person conference for the first time since the pandemic spread in 2020. The heavyweight lineup It's headlined by Fed Chair Jerome Powell. She'll give a speech on Friday morning at 10 a.m. Washington time. Powell's remarks will actually be live streamed from the lodge in Wyoming's Grand Teton National Park, taking viewers for the first time inside the conference room where the Fed has held its prestige retreat since 1982. The conference will also be attended by notable international luminaries, including those from the Bank of Japan and the Bank of England. Papers will be presented on Friday and Saturday and will look at topics including maximum employment, potential output, fiscal straits, and central bank balance sheets. Well, one big yawn there, I think. 4 academic papers will also be presented on Friday and Saturday, and there'll be a panel discussing featured policymakers each day as well. The Friday panel is titled An End to Pre-Pandemic Trends or Just a Temporary Interruption, while the Saturday panel is titled The Outlook for Policy Post-Pandemic. So all up, it's a central planner's hot dream. Us, mere mortals, can only stand back and watch. How good is democracy? I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.